Let's talk about what just happened in silver, because this move isn't normal. I'm not exaggerating. Silver just ripped almost 9% in a single trading day. That's after being crushed 40+% in roughly 1 week. It's like watching a roller coaster rocket straight up after plunging off the tracks. And here's the thing. This isn't random noise. The violence of that snapback is a clue about what's really happening beneath the surface. If you're holding silver right now, if you're watching this chaos unfold, wondering whether to buy the dip or run for the exits, stay with me. I'm going to show you how to spot this same pattern next time, before the headlines explode. Your job isn't to predict where silver goes tomorrow. Your job is to understand the mechanics driving these wild swings, so you're not caught standing there when the next wave hits. Before I explain what caused this, let me teach you what you're actually looking at. Most people hear silver jumped and think, cool, price went up. But silver isn't a simple up or down story. It's a leverage mirror of sentiment. Emotional, liquidity-driven, and lightning fast when crowds panic. Think of it like a spring that's been overstretched. When traders chase parabolic gains, they pull that spring tighter and tighter. The tension builds. Everyone's excited. Price is climbing. Then suddenly, it snaps. Once tension snaps, the recoil is brutal. That collapse from $122 down to $71 wasn't some glitch or computer error. It was pure exhaustion. Everyone who bought late was suddenly underwater, and margin calls started kicking in. When you're buying on margin and the price collapses, your broker doesn't ask politely if you'd like to sell. They force you out. That's what happened. Forced sellers dumped everything at once. But here's what happens next. When those forced sellers finish dumping, when there's nobody left to panic, the spring releases. Prices scream upward again. You're watching energy unwind. Not logic, energy. If this is making sense, and you're starting to see markets differently, drop a comment below and let me know you're following along. This gets deeper. Now here's what's actually happening underneath Tuesday's surge. This wasn't about new buyers rushing in with fresh capital saying, wow, silver's a bargain at 71, let me load up. No, this was short covering, mechanical rebalancing, and algorithmic reaction. Let me break that down. When silver nosedives that hard, big funds trim risk. That's automatic. Some short sellers, people betting the price will fall, they press their bets lower. They add to their shorts. But others, the smart ones, they start taking profits. They've made money on the way down. Now they're buying back their shorts to lock in gains. That triggers auto-buy programs. Imagine dominoes falling in reverse. One system covers their short position, another algorithm interprets that buying as momentum reversal, and suddenly everyone piles back in. The price explodes. But underneath all that fireworks, positioning is still fragile. Retail traders who chased the breakout above $100 didn't magically recover their losses because silver bounced to 77. They're sitting on bruises, hoping for a miracle bounce that gets them back to break even. Meanwhile, institutions, the big players, they're eyeing $75 to $80 as the zone to reload if the market snaps back down. That's why volatility isn't dying anytime soon. The tug of war between trapped longs and opportunistic bulls is what fuels these wild intraday swings. You've got people desperate to get out fighting against people looking for the bottom. That creates chaos. But here's the part that should make you nervous. Volatility clusters. It doesn't just vanish overnight. It migrates. You'll see calm hours, maybe even a calm day, followed by violent jolts. People mistake that quiet for safety right before the next burst. I've watched this happen dozens of times. The market goes quiet, everyone relaxes, then boom, another 5% move in 20 minutes. This is how markets test emotional endurance as much as capital. Can you handle watching your position swing wildly without panic selling at the bottom or FOMO buying at the top? That's the real test. And what very few people are talking about right now is what this tells us about liquidity conditions across the entire system. Silver doesn't move in isolation. When you see violence like this in a commodity market, it's often a sign that leverage is unwinding somewhere. Maybe it's hedge funds getting margin calls. Maybe it's systematic funds hitting risk limits. Whatever the source, when liquidity tightens, assets with high leverage ratios move first and move hardest. Silver's one of them. So if you're watching crypto, if you're watching energy stocks, if you're watching anything with embedded leverage, pay attention. This silver chaos might be the canary in the coal mine. And yes, we've seen this movie before. Go back to 2011. Silver shot from under $30 to almost $50 in just weeks. Everyone thought it was going to 100. Then it cratered 40% before stabilizing. Same pattern. Parabolic rise, euphoria, collapse, slow recovery. In 2020, pandemic liquidity pumped metals into the stratosphere. Central banks were printing money like it was going out of style. Silver rocketed higher, then flushed halfway down within days when reality set in. The technical shape hasn't changed because human behavior hasn't changed. When you zoom out, these spikes and collapses make a stair-step rhythm. Surge, shakeout, retest, then trend. It's not random, it's a pattern. So instead of asking, oh, is this bounce real? Start asking, where are we in that cycle? Usually, after a vertical reversal like this, markets spend days or even weeks chopping sideways, flushing out weak hands before any meaningful recovery. Tuesday's fireworks might only be the first shockwave. There could be another leg down to test support again before we get any sustained move higher. Or we could chop sideways for 2 weeks, boring everyone to death. Either way, understanding the cycle keeps you from making emotional decisions. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could silver truly be leading a new bull phase? Sure, maybe. There's a narrative floating around that supply conditions are tightening, that industrial demand for solar panels and electronics is growing, and that central bank buying could underpin the metal for months. Could this 8.6% jump be the turn? Possibly. I'm not dismissing it. But here's the thing. Data doesn't show confirmation yet. Volume patterns look reactionary, not foundational. When I look at correlated assets like silver miners, they're not confirming this move with strength. If silver was truly starting a massive bull run, you'd expect miners to be flying. They're not. What this tells me is keep an open mind, but don't get hypnotized by one big green candle. One day doesn't make a trend. Focus on what you can control, your risk, your entries, and your emotional discipline. It doesn't actually matter whether some fund manager got caught on the wrong side or whether there's some hidden supply shortage the market hasn't priced in yet. The mechanics are what matter. Can you read the structure? Can you manage your position? That's what determines whether you make money or lose it. There are probably 3 types of people watching this right now. First, the anxious new trader who saw silver's bounce trending on social media and thinks, did I miss the bottom? Should I jump in now? My advice to you, slow down. Learn what causes rebounds before betting on them. This is where tuition fees get paid in pain. You see a 9% move and think it's easy money. It's not. By the time you hear about it on Twitter, the move's already happened. The risk reward has flipped. If you're new, your job right now isn't to trade this. Your job is to watch, take notes, and learn the sequence. Watch how price behaves around key levels. Watch how volume changes. Watch how sentiment shifts. Build your pattern recognition without risking capital. That discipline will serve you better than any trade you force right now. Second, the seasoned holder who's been accumulating metals for years. You're probably nodding quietly, knowing this pattern all too well. You've seen 2011. You've seen 2020. You've seen silver do this dance before. For you, patience beats prediction. Let volatility work to your advantage. If you believe in the long-term thesis, use these washouts to add at better prices. Don't get shaken out by short-term chaos. Your edge is time horizon and emotional stability. The new traders panic selling at 71 are handing you opportunity if you've got the conviction to take it. Third, the macro-focused investor watching inflation data, interest rates, and liquidity flows. You care less about daily ticks and more about quarterly trends. For you, silver's chaos is a signal about dollar liquidity tightening. Keep that on your radar because it spills over into everything. When liquidity dries up, correlations go to 1. Everything falls together. When liquidity returns, assets decouple and start trading on fundamentals again. Where we are in that cycle matters more than silver's daily price. Whatever camp you're in, the same principle applies. Markets are feedback loops of psychology and positioning. Recognize the emotion, but trade the structure. So here's what I want you to answer in the comments. Which type are you? Are you the new trader trying to learn, the long-term holder staying patient, or the macro investor watching bigger trends? Let me know, because I want to tailor future content to what you actually need. So here's where I stand. I'm not calling a moonshot rally, and I'm not calling doom. I'm standing in the middle, watching the mechanisms. Let me tell you what I'm personally watching. First, I'm watching that $75 to $80 support zone. If silver drifts down there without panic, without another violent flush, that could signal stabilization. It means sellers are exhausted and buyers are stepping in calmly. That's healthy. Second, I'm watching option skew. When traders stop paying up for downside protection, when put options get cheaper relative to calls, volatility may compress. That would tell me the fear trade is cooling off. Third, I'm monitoring volume confirmation on any break above $90. If we see silver push through 90 on heavy volume with miners confirming, that's where conviction separates from noise. That's where you'd start thinking, maybe this is real. But here's my honest assessment. This move on Tuesday was mechanical, not mystical. The fundamentals, mine supply, industrial demand, monetary flows, they haven't drastically changed in 48 hours. What's changed is sentiment, and sentiment moves faster than metal. The actual physical market for silver hasn't transformed overnight. What transformed was positioning and emotion. That's important to understand. It means this bounce could fade just as quickly as it appeared if the underlying conditions don't support it. Based on my analysis, this event was technical and structural, not fundamental. The fundamental picture for silver hasn't changed dramatically. Yes, there are long-term supply concerns. Yes, industrial demand is growing. Yes, central banks are buying gold, and that sometimes spills into silver. But those are slow-moving forces. They don't explain a 9% move in one day. That's pure positioning, pure mechanics. If history rhymes and silver continues consolidating in this $70 to $90 range, the move that follows could be significant. But I'm not making predictions. I'm watching for confirmation. I'm not a financial advisor. This is not financial advice. I'm sharing my process for analyzing markets. You need to do your own research, understand your own risk tolerance, and make your own decisions. If you made it this far, you're thinking critically. You're not just chasing headlines. That mentality will serve you well. Most people won't watch a 16-minute breakdown of silver mechanics. They'll see a headline, make an emotional trade, and wonder why they lost money. You're different. You're building real understanding. That's your edge. If you found value in this breakdown, share it with someone who needs to see markets this way. Hit subscribe if you want more pattern recognition and mechanism breakdowns. And stay ahead of the headlines by learning to read the structure before the story gets written. Stay sharp out there. Think critically, verify every data point,